Well, hi everybody. Thanks for hitting play and watching our video here. I'm Larry DeBoer. I'm an emeritus professor of agricultural economics from Purdue University. Emeritus professor means has been, but I was a professor at Purdue for a very long time. And I'm pleased to be with you here and at the invitation of the Indiana Fiscal Policy Institute to talk about the Indiana property tax reform of 2025. Now, I've written a paper. Actually, I've written three papers last year. Wrote a paper called 50 Years of Indiana Property Tax Policy. You can find this one and the other two I'm going to show you on the IFPI website. But that one kind of looked at the history since 1973 all the way up to about 2020. And then I wrote a second paper called The COVID Pandemic and the Indiana Property Tax, which was what happened to Indiana's property tax during the pandemic. And what happened during the pandemic caused a lot of discontent, shall we say, among property tax payers. And that led to a new policy, the property tax reform of 2025. And that's the paper we're going to talk about today, the Indiana property tax reform of 2025. And while those other two papers look backwards, look back at history and use data from history, this paper is a little bit more speculative because we're looking ahead to 2026 through 2031, which is the period of time through which the property tax reform is going to phase in. So we are a little bit handicapped in the sense that we don't know exactly what's going to happen with property values and the economy and everything else in the future. So this paper is a little more speculative, a little more forward-looking, a little more extrapolated than the others. But I think it's important to try to figure out just what the impacts of this reform might be through 2031. Well, let's take a look now at what the bill actually does. I call it the third major reform of the past 50 plus years, after the Bowen reform of 1973 and the Daniels reform of 2008. I suppose eventually we'll call this the Braun reform of 2025. But here are some of the things that it did. Deductions, or it's going to do, makes big changes in deductions. It phases in a higher homestead supplemental deduction. It phases out the fixed $48,000 homestead standard deduction. And it phases in a new deduction for what are called 2% property, that's non-homestead residential property, and farmland. So big changes in deductions. Exemptions. We have some new exemptions. Now, exemptions are different from deductions in that exemptions are property that doesn't even get assessed. Deductions are subtractions from the value of property before you apply tax rates. Exemptions are saying, hey, we're not even going to assess this stuff. The de minimis exemption for personal property is being raised to $2 million. De minimis means not dealing with minor things. And the exemption these days is $80,000, which basically says, hey, if you got less than $80,000 in property, it probably costs more to assess it than the revenue we'll earn from it. So let's ignore it. Moving up to $2 million, that's a little bit less de minimis than $80,000. I wouldn't call it de maximis, but it's pretty big. I think we're talking about an economic development program now rather than simply an administrative exception. And then we're going to eliminate the famous 30% floor on new personal property purchases starting in 2026. So if you buy property next year and every year after that, it will not be limited in depreciation to 30%. The farmland capitalization rate is going to be raised for taxes in Pay 2026 and Pay 2027. And I'll explain what that is, but it's a part of the farmland capitalization formula, the base rate formula. And when the rate is raised, the base rate, the starting point for assessment, goes down. There'll be a new supplemental homestead credit applied after the circuit breaker cap credits, and that means that everybody benefits from it. And so we'll talk about that. Then there's some other things that it does that we won't talk about here in the talk today, simply because I'm looking at just the property tax parts of this, and I'll be talking for long enough without adding all this other stuff. But the paper covers it. The restructuring of local income taxes, a major restructuring of local income taxes, including the elimination of the local income tax, property tax relief tax rates, and referendums. School referendums, in particular, are restricted to November general elections. General elections are even year elections, and the referendum ballot text is going to be changed as well. So we're going to talk about the deductions, the exemptions, the capitalization rate, the supplemental homestead credit, and try to look at the impact on both local governments and on taxpayers from those changes. And I really recommend the information on the local income taxes and the referendums that you can find in the paper. All right. One thing that we need to say about what I'm going to talk about here and the way that you look at policy, there's really two ways to look at policy, that is, the changes that policy makes. You could compare the results of your policy to a forecast of what would have happened had the policy not been changed. That is, you imagine an alternative universe where the policy was never changed and say, how is the world different from what it would have been? And this is an excellent way to look at policy change for policymakers. Because if you don't look at it that way, if you simply say, hey, let's just see how things changed after we instituted the policy, well, then some of the good things and some of the bad things that would have happened anyway get attributed to your policy. You get an erroneous idea as to what impact your policy made. So compared to the world as it would have been had your policy not been changed. Well, that's great for policymakers, but that's not how real human beings think. Human beings compare policy results to what happened the year before. And so we need to have a forecast of year-to-year changes as another way to look at policy to get at what really will be the experience year-to-year of the taxpayers and the local governments. To sum it up, we want to compare what would have been, or we want to compare what was. That is, compare your policy to what would have been, or compare your policy to what was. That is, what happened last year. And I will try as we go forward to let you know which kind of comparison I'm going to be making, and we will try to use both of these comparisons to get a full view as to what the impact of these policies just might be. Right, let's start out with deductions and exemptions. And since most folks I'm talking to are probably homeowners, let's start out with the homestead deductions. Now, what you're looking at here in this table is the same sort of information at the top of the information sheet that the auditor and treasurer sends you every year with your property tax bill. And even if you pay it in escrow, they will send you the information. And what this is moving from the gross assessed value of a house, and the gross assessed value is set by the assessor, and it is an attempt to predict what the selling price of your house would be if it were put on market. And then we move down to the net assessed value or taxable assessed value, and that's the number, the dollar figure to which tax rates are actually applied. That's the number that you pay taxes on. And so to get from one to the other, you subtract deductions. Now let's take the third. Let's get the cursor working here. And let's take a look at this third column here. And this is the existing policy that we have right now as of 2025. And let's suppose that we have a house with a gross assessed value of $234,500. And why that number? That is just about the average gross assessed value of a homestead, an owner-occupied primary residence. Average assessed value of a homestead in Indiana here in 2025. First thing we do under the current system is subtract off the homestead standard deduction, which is $48,000 for everybody. The remainder is $186,500. And then we take the supplemental deduction percentage, which is 37.5%, multiplied by 186,500. That gives you 69,938. You subtract both the 48,000 and the 69,938 from the 234,500, and you get $116,563. So the average homestead in Indiana is taxed on just about half of its actual value, of the actual gross assessed value. Now, what's it going to look like under SEA 1? And I say right there in the heading, SEA 1 2031. and that is what will Senate Enrolled Act 1 look like once it's fully phased in by 2031. And so we start with the same gross assessed value, 234,500. The homestead deduction is being phased out entirely, so it will not be subtracted. So the remainder is the same as the gross assessed value. And the supplemental deduction will be increased step by step over 6 years from 37.5 to 66.7, or just a little more than 2/3. So we take 2/3 of 234,500, it's 156,412. We subtract that from the gross assessed value, and we get $78,089. And that is 33% less than it would have been under our current system. So this is a comparison of what is to what will be. That is a comparison of the alternate universe, what things would look like if SEA 1 were applied to the same house now to what actually exists right now. The bill, the changes in deductions will reduce the taxable assessed value of a homestead by 33%. And that's the average homestead. Let's take another homestead. And those are the first two columns there. An $80,000 homestead. Now, if you're sitting out there in a suburban area or an urban area, you might say, who's got an $80,000 house? There certainly aren't any $80,000 houses in my neighborhood. Well, if you go to rural Indiana, you will find there are really quite a few houses assessed at less than $80,000. I checked Jay County, and I hope I have this number right, but I think about a third of the homesteads in Jay County, a rural county northeast of Muncie, have home values of less than $80,000. So this is the reality for a whole lot of folks. So if you got a low valued house, how does it work right now? Well, you subtract $48,000 at the start, and that is a really big part of your $80,000 home value. That leaves $32,000. You then take the supplemental deduction percent of 37.5. That leaves $12,000, or that is $12,000, the supplemental deduction. When you subtract the 48 and the 12 from the 80, you end up with $20,000, or a 75% reduction in the gross assessed value to get to the net assessed value. Well, what happens under SEA 1 by 2031 when it's fully phased in? The homestead deduction is gone, the supplemental deduction is 66.7, and the taxable assessed value is 26,640, 33.2% higher than it is now. So a comparison to what would have been for a low-valued home shows an increase in net assessed value. And let's point out why this happens, because it'll come up a few more times in the talk here. That's due to the homestead standard deduction. It's fixed for both of these homesteads, but for the lower valued homestead, it is a very large percentage of the total. And when you add that to the 37.5%, you get a 75% reduction in taxable net assessed value from the gross. And that's more than the 2/3 they're going to get under SEA 1. So the elimination of the $48,000 fixed deduction is costly to lower valued homes. Now, I did the algebra and figured out that the break-even gross assessed value is the strange number $102,740. So if you've got a home of that value, then the two systems produce the same net assessed value. Well, that, as I said, is a comparison of what is to what would have been. So let's do that calculation for all 92 counties. What you have here is a graph that shows two different calculations. The red line is just what we just did, okay? So you go back and you see, hey, we did it for an $80,000 house. We did it for a $234,500 house. For the $80,000 house, we saw a 33% increase. For the 234, we saw a 33% decrease. And that's what the red line does. It takes lots and lots and lots of different home values, all the way from 20,000 all the way up to 500,000, and plots the increase, or for most homeowners, reduction in net assessed value that would occur if SEA 1 had been in place relative to the policy we've got now. What the dots are for each county saying, hey, let's apply the SEA 1 deduction to current data to what existed in 2025 and compare it to net assessed values in 2025 for homesteads and see what the actual reduction was for the 92 counties. And what you see, the dots are pretty darn close to the line. And that tells me that a couple of things. It tells me, number one, that a methodology for analyzing the policy of taking what's happening to individual homesteads, to individual properties, and then extrapolating that to the whole community, to all of the assessed value in each county or all the assessed value in the state, that policy should work, that method, I should say, should work pretty well. And so that's what we're going to do. But the other thing it tells you is take a look at as the average gross assessed value of homesteads goes up, the amount that net assessed value is going to go down increases. Right? For very low valued homes, the decrease is actually very small. But when we get up to counties that have very high valued homes, the decrease gets up to about 40%. Now, who are these two counties here? That's Boone County and Hamilton County, where there are lots and lots of very high valued homes, the average in the 400,000s. And those counties are likely to see substantial reductions in their net assessed value as we go forward with the SEA1 phase-in. As these deductions are phased in, the losses compared to what would have been the losses will be quite high for places with lots of high-valued homes and not so high for places with low-valued homes. So that's a rule of thumb for the counties out there wondering what the effect of the policy is going to be on their own county finances. Well, let's take a look at it from the other point of view compared to what was. Let's look at what might happen year to year as the homestead deductions are phased in. And the middle column here show how the phase in is going to go. So here's the standard deduction starting at 48,000, and as you can see, it phases out by 2031. The supplemental deduction phases in by 2031 from 37.5 to 66.7. And by the time we get to 2031, the standard is gone. I'm guessing that at some point in the future we'll change the name supplemental deduction to just deduction because it won't be supplementing anything anymore. But at any rate, 66.7% phased in by 2031. Here's gross AV, and I said let's take the average gross AV and let's increase it year by a certain percentage. I picked 5. 5% increase is less than it's been the last 3 years. It was about what it was from 2018 to 2021 before the pandemic had its effect. It's more than it was before that. So we'll take 5%. It's not a prediction, not predicting that that's what's going to happen. I don't know what's going to happen to the gross assessed value of homes, home values over the next 6 years. But 5% seems like a plausible number, and it allows us to take a look at the impact of the policy. If we applied the current policy, the one we have here in 2025, the net AV, as you can see, would increase. So here we're subtracting 48,000 and then subtracting 37.5% of the remainder. And what you see is that net AV actually increases more than gross AV under current policy. And that's because the 48,000 doesn't rise proportionately. The standard deduction stays the same. It becomes less and less important in reducing net AV as we go forward, as the gross AV gets bigger. So net AV increasing more rapidly than gross AV, or it would under our current policy. What's going to happen under SEA1 as we change the deductions as we go along? Net AV, as you can see, actually goes down and ends up lower in 2031 than in 2025. Now it's 37% lower than it would have been had the policy changed. So that's compared to what would have been. But here's the comparison at the end here to what was. Right? So in the first year, it's 2% higher. But after that, as these deduction changes really get going, we see that net assessed value declines every year and declines by an increasing amount as the standard deduction phases out and the supplemental deduction phases in. So a 10.2% decrease compared to what it was in 2025 a 37% decrease compared to what it would have been had the policy not been changed. So that's how it's going to phase in. And it means that net assessed value for homesteads unlikely to increase over the next few years in many, many counties in Indiana and for many, many homeowners. All right, let's move on to the new deduction for 2% property, and let's start with non-homestead residential. So this is mostly rental housing, but also second homes and vacation homes, group homes, things like that. And we've got a brand new deduction for these folks. The 2% property, non-homestead residential property, doesn't get very many deductions right now, but we're going to give them a great big one phasing in from 2026 through 2031. And as you can see, it phases in all the way to 33.4% by 2031. So a little bit more than 1/3 subtracted from gross AV to get net assessed value by 2031. Going to do this with an index since it's proportional. You don't need to put a dollar amount in there. So we'll just use an index of 100. And let's suppose, again, we have a 5% annual increase. If we do that, then we get that 34% increase in gross AV. But now the net AV index says what happens if we apply the phased in deduction on 2% property. And as you can see, it decreases. And it again decreases by a similar amount to homesteads, 10.7%. And it will decrease every year. So compared to what would have been, it is lower and it changes year to year negatively. It declines every year, year to year. So owners of this kind of housing, owners of rental housing, owners of second homes will likely see their assessed values decline year by year by year over the next 6 years until we get to 2031. And after that, it'll be proportional. And a 5% increase in gross AV would cause a 5% increase in net AV. Farmland is a little more complicated because we assess farmland not at its predicted selling price, but we do it with a capitalization formula. We take average farm income, an average over 6 years, and I'm using $191 because that's what it was in 2025. Then we divide it by a capitalization rate. The capitalization rate we've been using is 8%. And so 191, you see there, divided by 8% gives us what's called the base rate, which is a dollar amount per acre. And that's the starting point for the assessment of farmland. And the base rate was $2,390 for taxes payable in 2025. Now, the 2% property deduction up to 33.4% will now apply to farmland, and farmland owners have never gotten really any deductions at all. So this is a major change in our treatment of farmland property. But the other thing it does is, as you can see, in 2026 and 2027, we're going to raise that capitalization rate to 9% just for those 2 years. And I should tell you that the cap rate is in law. It's not taken from any interest rates out there. It can be either 6 or 7 or 8% currently. But we've had this formula for about 10 years, and it's never come out. It's never picked any cap rate other than 8%. So we'll assume that would continue. And the highest rate of 8% is going to be increased to 9%. Well, if you divide 191 by 9%, you get 2120 and 2,120. Which would be a reduction in the base rate due to that increase in the cap rate. Now, you'll notice I'm leaving farm income average at 191 throughout this period here, and there's 2 reasons for that. One is the formula is backward looking. That is, it takes 6 previous years to average and averages them together. And so, farmland averages or farmland income has been declining over the last several years, and those declines, that data will remain in the formula as we move forward. And it's also true that at least some of the projections I've seen is that farm income is not likely to increase very much, not expected to increase very much over the next several years. But at any rate, we'll use the 191, as you can see. Now, what happens when to farmland when you apply the new 2% deduction and the new 9% base rate? As you can see, we get a decline in every year except 2028, and that's the year that the farmland capitalization rate shifts back from 9 0.28. But other than that, we see some pretty substantial reductions in farmland net assessed value and the change. As you can see, I don't know where that zero came from, that doesn't belong there, but the 33.4% is the change that you see in total. So that's the change in farmland net AV compared to what it would have been, and a decline each year, except 2028 in farmland. So we're going to see rental housing net assessed values go down year after year for the most part through 2031, and we're going to see farmland assessed values go down year after year for the most part through 2031. Now let's talk about personal property. And personal property is mostly business equipment. And the big change in personal property is we're going to exempt $2 million. Now we're going to put on a $2 million personal property exemption. And what this means is that if your business owns $2 million or less in personal property, that is the cost you paid to buy the equipment that you own, if that cost is less than $2 million, you will be exempt from the personal property tax. That is, you won't have to pay property taxes on that equipment. Now, in order to figure out which firms would be newly exempt from this policy change, we would need to know the acquisition cost of a firm's personal property. That is, what's the total amount they paid to buy all of the property that they happen to own, all of the equipment that they happen to own. Unfortunately for the researcher, the acquisition costs are confidential information. They're on the tax forms, but that part of the tax form, that information is not released to the public. So we don't know what the acquisition costs are. So I have to fall back on trickery to try to figure out which firms are going to be newly exempt so we can figure out how much of the assessed value of personal property is going to be removed from the tax base. And that's why I've shown you this chart right here, this bar chart. And what this is the remainder of the assessed value after depreciation in pool 2, which is a pool that goes for 8 years before it hits bottom at 15%. And an awful lot of the personal property of businesses is placed into pool 2. And so what the numbers mean there, the 40%, as you can see for new, means that when you buy a piece of equipment, you take the acquisition cost, you multiply it by 40%, and that's the assessed value that you will pay on. As it happens, the percentage in year one, that is the year after you bought the property, is 56%, and that's as high as it gets. So here's the trick we're going to use. We're going to say, hey, imagine you've got a firm that has all of its property in that one category, in that first year of acquisition at 50%. If you had $2 million of personal property and you took 56% of it to get the assessed value, you would come up with $1.12 million. That is $1,120,000. What that means is that if we have a firm, since that 56% is the highest rate, if we have a firm with more than $1.12 million in assessed value, which is a number we know, then we know they must have at least $2 million in personal property, and they will continue to be taxed. If you have less than 1.12 million in assessed value, well, then we can't say for sure. Then you might be exempt, but you might continue to pay. And so we're going to use that number, 1.12 million. And I got the folks at Policy Analytics, a consulting firm in Indianapolis, to run the numbers for me. And they came up with a number that said, gave us how much, what is the value of personal property at more than 1.12 million and less than 1.12 million. And so what we've got, if we do that, is that's the biggest loss in assessed value possible. Can't be any more than that. So we can at least say that, right? What is the biggest possible loss? One interesting thing about personal property in Indiana is the ownership of it is very skewed. If you look at the number at the firms that have more than 1.12 million in assessed value, they make up only 1.7% of all the business firms. That is, 98% of business firms might become exempt from taxation. But that 1.7% of taxpayers owns 72.3% of all the assessed value. And so when you think of business equipment, you think of the big electric utilities and the big manufacturing firms and the steel mills and the auto plants and all of that, they own most of the personal property. Right? Small businesses make up about a quarter of it, and the big businesses make up about three-quarters total. So very skewed. So yes, we're going to exempt 2 million. We're going to end up exempting the vast majority of businesses, but most assessed value, the lion's share of assessed value, will still remain taxable. Well, suppose we did that with the counties. We took the personal property in the counties and we said, how much personal property would be lost? What percentage of the value of personal property would be lost if we eliminated all the businesses with less than 1.12 million in assessed value? Now, of course, some of those firms will remain taxable. So again, this is the maximum amount that could be lost. And on this scatter diagram, on the vertical axis, you see percent potential net personal property AV loss. That is, that's the percentage that the counties would lose if everybody under 1.12 million was exempt. And down here, we've got the percent of personal property in total net AV. Now, I thought, and maybe it seems obvious, but turns out not to be true. I thought that if you got a lot of personal property in your total net assessed value, you'd be really vulnerable to losses from this exemption. But it turns out it's just the opposite. Isn't that weird? Look at these counties down here, right? These are the counties that have the biggest percentage of personal property in total net AV. That is, business equipment makes up 35, 40% of their tax base. They have the smallest reductions in personal property. Why is that? These are the rural counties with electric utilities. These are places like Pike and Gibson counties, where a very large part of their tax base is the assessed value of a big electric utility. Well, big electric utilities have way more than $2 million in business equipment, and so they will remain taxable. They've got a lot of property in personal property, a lot of their tax base in personal property, but most of it is in great big firms that will remain taxable. Take a look at these orange dots right here. Those are the 20 largest counties in Indiana by gross AV. And as you can see, their losses are all less than 40%, but their personal property percentages are also small. So why are their losses low while their percentages are small? They do have a lot of big firms in those big counties. These are the big urban and suburban counties, lots of big firms. So that keeps their personal property losses small, but they've got so much other property, high priced property, high assessed property, that the share of those big firms in the total tends to be rather small. So who are the counties who have more than 40% of their assessed value declining? They're the ones with lots of smaller businesses. They don't have the great big businesses that continue to be taxed, but they have a lot of smaller businesses that will be newly exempt. So most of those, in fact, all of them, are among the 72 counties that are smaller in terms of assessed value in Indiana. And those are the folks who are most vulnerable from the $2 million property exemption. Now, the 30% floor. So what is this 30% floor that is now going to be eliminated starting in 2026? The 30% floor is a business takes the total cost of their acquisitions, that is, they've added up what it cost them to buy all of their equipment, and then they do the depreciation and come up with what remains here using this schedule here, this true tax value percentages. But if the total turns out to be less than 30%, then they must set their assessed value at 30%. Even if their assessed value, even if their equipment is all old like this and and by the depreciation rates would be taxed at just 15 or 20 or 25%, they still have to pay on 30%. That's the 30% floor. And it keeps the personal property higher than it would have been. Well, we're going to eliminate that starting in next year, starting with property purchased next year in 2026. All the property older than that, purchased this year and before, will remain under the 30% floor. Everything going forward will not be subject to the 30% floor. And so I think we can say a couple of things for sure. Now, of course, we don't know the acquisition costs and we don't know the vintages of the acquisition costs either. To figure out what, really figure out what this would do, we'd need to know not only what are the acquisition costs for firms, but in which year they are, which level of true tax value percentage is being applied. And we don't know that. Right? We haven't got that information. So what can we say? Well, we can say one thing for sure is that in the long run, when all of the old property is finally retired from service and is no longer assessed, then assessed value of personal property will be lower than it would have been had we not eliminated the 30% floor. Now, how long will it take for all of the property purchased before 2026 to be retired from service? Well, probably a long time. I think we're probably talking decades here. But when that happens, in the long run, the assessed value of personal property will be lower than it would have been under the 30% floor. I think we can also say that in the short run, that is in the first 4 years, that is, and this is 2026, 27, 28, 29, 2030 is year 4. Before 2030, the policy cannot reduce assessed value. Why? Because all the new property will be assessed at more than 30%. So the 30% floor never would have applied in the first place. And so it can't have an impact to reduce assessed value before then. So long run, going to reduce it. No effect in the short run. What about in between that? And this is one of the most counterintuitive things I think I've ever run into. But take a look at this. This is a little complicated, so let me walk you through it. What I've got across here are the years of acquisition. That's the years 1, 2, 3 through 6 plus from this chart right here. And here are the true tax value percentages. And there's your 56 right there. And there in year 4, it's dropped below 30%. And let's suppose it's year 2031. Right? So we're beyond the point where some of the new property is now going to be affected. And so we've got this firm, and let's suppose we have a firm that operates this way, buys $1 million in new equipment, and these are all in thousands, just so I don't have to tack on zeros, $1 million in new equipment every year for 10 years, and then the property wears out and it gets retired from services. So if you did that, you'd have $1 million here new in 2031, and $1 million that you bought last year in 2030, and $1 million, and then in 2025 or before, you'd still have $4 million in property left. Here's the existing policy true tax value percentages, and here's the SEA one. The percentages haven't changed. So this is 40% times $1 million is 400, 56% times $1 million is 560. And when we add that up, we add those numbers up, and here's $4 million here times the 15%, so it's $600 or $600,000. That adds up to $2,720,000. That is less than 30% of the $10 million total. And so the 30% floor would apply, and the total AB would be $3 million or $3,000. Under SEA 1, how do we do it? Well, we still take this sum right here, but the post-2025 is not subject to the 30% floor, so we add that up separately. It adds up to 2120. These 1, 2, 3, 4, 5, 6 years of numbers adds up to 2120. And then the 600,000 here out of 4 million, that turns out to be less than 30%. 30% floor out of 4 million is 1.2 million. You add the 21,120 and the 1.2 million, you get 3,320,000. The policy has increased the net assessed value of personal property. A policy eliminating the 30% floor progressively after 2026 raises the taxable value of personal property for this firm. Why is that happening? It's because we are segmenting the old stuff. Under the current policy, some of the amount that they are below 30% of the old stuff is below 30% is kind of offset by the new stuff being above 30%. But once you've segmented, that offset never happens, and you end up with a higher assessed value. Well, what can we say about that? Now, I mean, is that plausible? I don't know. I mean, we don't have no idea what the acquisition cost distribution across years looks like. So I don't know how firms purchase a property, but it certainly looks possible that such a thing could happen, that an increase in personal property could occur. So what do we know about the 30% floor on new acquisitions? In the short run before 2030, the policy can have little effect. PTV percentages are greater than 30% on new equipment in the first 4 years. In the long run, when all personal property purchased before 2026 has been retired, personal property AV will be less than it would have been with a 30% floor. We know that for sure. And in between, it's possible for personal property assessed value to be higher under SEA 1 than it would have been with a 30% floor. So, what can we say? We can say, my conclusion is the elimination of the 30% floor after 2020, after 2025 on acquisitions and 2026 after, elimination of the 30% floor could decrease assessed value, could leave assessed value unchanged, or could increase assessed value. That's my conclusion, and you heard it here first. All right, let's carry this on forward now. Let's combine it all together, take a look at what total net assessed value might look like and what that will do to tax rates. The first way I want to try to get at this is another one of these comparisons to what would have been. Let's compare actual data from 2025 to what would have been if SEA 1 had been fully phased in 2025. What you see here in the left three columns is the actual 2025 assessed values. GAV is gross AV, net AV, net assessed value here. And just to illustrate what's going on, this is the net AV as a percentage of gross AV. That is, how big is the remainder that we're actually taxing after we apply the deductions. For homesteads, as you can see, it's about 1/2. And so that's why the average homestead works for the total, but this is a total here in millions of dollars, $447,322,000,000 right here. 49.6% of it is taxable. Here's non-homestead residential and farmland. That's that 2% property. And as you can see, they get very little in deductions right now. Here's business real. The subtractions that they get from gross to net are the abatements the economic development policy abatements that businesses get, and the same thing with personal property, as you can see. So in total, we assess about 2/3. Net assessed value is about 2/3 of gross assessed value. You then take the levy, which is $12,511,000,000. That's what local governments raised from the property tax. And in order to establish the rate, what local governments do is to divide the levy by the net assessed value. So $12.5 billion divided by $525 billion ends up at $2.38 and change per $100 assessed value. And that's the average tax rate in Indiana. What if the SEA 1 deductions and exemptions were applied to 2025 data? Well, we've already seen the 33.8% decline in homestead deduction, in homestead net AV, 35% decline in net AV of non-homestead residential and farmland. No change in business real property, business land and buildings did not get any extra deductions or exemptions from SEA 1. And then here's business personal. Here you see the percentage is down, but you also see the gross AV has gone down. Right? We are exempting, not deducting here. So gross AV has declined, but the combined change there is 27.7% with net AV. When you add that all up, it turns out that the net assessed value in 2025 would have been lower by 26.9% had SEA 1 been applied. Now, remember, this 27.7 is the maximum possible number if we assume that all firms with less than $1.12 million in assessed value are exempt. And we know that won't be true. Just to see what would happen, I said, hey, let's cut that in half. Let's assume that half of that assessed value will remain taxable. In that case, if you feed that number in, so the number is about 14%, This turns out to be 25.4%. So whatever happens with business personal property, it looks like the reduction would be about a quarter, about 25% or so, what would have been compared to what actually existed in 2025. What would happen then if we took the $12.5 million levy and divided it by the remaining $384 billion in net assessed value? We get a tax rate of $3 and almost 26 cents. That is, the tax rate goes up by 36.7%. Now, to really illustrate how this plays out across the state, what I have here is a map that I've put together that applies what I just did for the state to all 92 counties and shows which counties lose more and which counties lose less. So the dark colored counties there are losing 29% or more in total net assessed value compared to what would have been had we not changed the policy, or rather, if we applied the policy in 2025 compared to what actually existed. The lighter colors there, the lightest color is less than 20%. There are some regional patterns to look at here. I noticed, for example, that these industrial counties from Howard to Wayne, I sometimes call it the old industrial corridor, they're losing less. Take a look at the donut around Marion counties, the suburban counties, they're losing more. Take a look at Brown and Kosciuszko and Steuben, where there are a lot of vacation homes, vacation rentals, and so forth. They're losing more. You look down here in southwestern Indiana, where you've got Knox and Pike and Gibson, up here in Vermilion, a lot of big utilities. They're losing less. And if you take a look at this swatch up here, those are the counties with the really good farmland. So farmland important in their tax bases. They're losing more. Let's run those in a scatter diagram. The last scatter diagram, I do love a good scatter diagram, as you can tell. But here's the scatter diagram that compares these losses, that is, on this axis here, the vertical axis. Those are the numbers from the map, the calculations of what losses would have been had SEA 1 been applied in 2025. And here's the share of business property in gross AV. That is, how important is business land, buildings, and equipment in your tax base? And as you can see, we've got a downward slope here. The more important is business property, the less you're going to lose in net assessed value. The less important is business property, or the more other kinds of property you've got, the more your net assessed value losses. This is a rule of thumb for counties out there. How much business property have you got? Now, why is that? Let's take a moment here to figure out why that is. Let's take a look at some counties. Let's look at those two there, the two with the smallest losses. And those counties, that happens to be the dots for Gibson County and Spencer County. And those are counties with big utilities, rural counties with big utilities. That is, they have a big share of business personal property, a big share of business property, but because that property remains taxable under the $2 million exemption, they don't lose very much. Take a look at the other end. Who's that right there? That's Brown County. Why would Brown County? Well, for one thing, it's got the smallest share of business property. Now, there's a lot of nice businesses in Nashville. I'm sure you've been down to Nashville, you know. It's a lot of nice businesses, but it's a small share of the total. The biggest share of the total in Brown County are the vacation rentals and the second homes. That's the big share of property that Brown County's got. And that property is getting a great big new deduction, the kind of deduction they've never had before, that 33.4% deduction. So Brown County shows a very large loss, a 31% decline in net assessed value compared to what actually existed in 2025. Finally, we got another one there, the biggest losses of all, almost 33%. That's Hamilton County. Why Hamilton? Well, we know they've got a lot of business in Hamilton County, right? But their share is small because they've got so much residential, and those houses are high priced. And so those high priced homes make up a big share of their tax base, which kind of means that the business share gets squeezed. And as we saw, high valued homes get bigger deductions, a bigger increase in their deductions from SEA1. And so you get a bigger reduction in assessed value. Let's sum this up. Let's give some rules of thumb. Why is a higher business share in gross AV related to lower potential net AV reductions from SEA1? Why does that scatter diagram slope downward? First of all, business real property doesn't get any new deductions. So if you got a lot of it, that whole chunk of your property is not going to be any different than it is today. Counties with lots of business real property have fewer added deductions under SEA1. Second, a high personal property share contributes to high overall business share and gross AV. Counties that have high personal property shares, as we saw, usually have big property taxpayers, big firms who will remain in the tax base. They will not be exempt under the $2 million exemption. So they don't lose much, and they've got a high business share. Higher supplemental deduction means that higher valued homes say bigger net AV reductions. So if you've got a lot of high valued homes, that means it squeezes your business share to a smaller number and you see bigger losses. A bigger share of rental housing and second homes means the business share is smaller. You got a whole lot of the rental housing, you got a smaller share of business. That housing gets a big new deduction under SEA1, and so that reduces net AVs. And then finally, you've got a bigger share of farmland. That means a smaller share of business property, not non-farm business property, of course. Farmland receives a big new deduction, first one they've ever received. So rural counties see bigger net AV reductions. So those are the rules of thumb that I think you can come up with this exercise of applying SEA1 to current data. These are the counties that will lose more. These are the counties that will lose less. If you've got a big business share in your total, you're likely to lose less in net AV. If you've got a small business share, you're likely to lose more in net AV. What's it going to look like year to year? Well, this basically takes what I've already done there and gives you the percent changes and then combines them into a total. And so you see the decline in homesteads that we saw before, the decline in farmland. There's that 3.6% increase when the cap rate goes back to 8. Business real, I'm assuming a 5% increase in their gross and net AV over this whole period there, and they get no new deductions. There in 2027 is when the $2 million exemption kicks in. So that's where we see the big decline in business personal. Other than that, I'm assuming a 3.5% annual increase. What do we get when we do that? When we take these extrapolations of increases in property values and apply SEA1 deductions and exemptions and add it up, what do we see? We see net AV 3.4% lower than it was in 2025, and we see declines, small declines in most years. Let's put that on a year-to-year chart, and I think this shows it the best. This shows the percentage changes in statewide net assessed value actual from 2006 out to 2025, and it's labeled with some of the things that explain why you see the unusual changes that you see. But I would point out that right before the pandemic, when we saw some big changes in assessed value, right there, these 4 years, the average increase in net assessed value was 4.6%. And those extrapolated numbers I just gave you, these right here, if you use our policy, if you take 5% growth in homesteads, in non-homestead residential, in business real property, and 3.5% in personal property, and you leave farm income unchanged, you get 4.6% with the current policies that we've got. What do we get under SEA1? As you can see, we get 6 years here of very little change in net assessed value. Essentially, no growth in net assessed value for 6 years. Now, are we going to grow 4.6%? Of course not. I don't know how we're going to grow, but the odds that my extrapolation will be right 6 years in a row are very, very slim. So what this really does is give us the wedge, right? If it's 4.6%, we get increases that are a little bit less than zero most of the time. If it was higher than that, we'd get some increases. If it would lower than that, we'd get bigger decreases. There's about a 5 percentage point wedge created by this policy change between what would have happened and what is going to happen, or what is likely to happen under the phase-in in SEA 1. So that is the reduction in net assessed value from what it would have been. And this shows you the change from year to year, the comparison to what was. What would that do to tax rates? Well, let's make yet another assumption. Let's suppose that the levy grows 4% per year. Now, that is slower than it has grown at any time since 2017, but it is the limit on the maximum levy growth quotient that the bill has put in for 2026. So we'll be conservative here and suppose that we're going to get a 4% annual increase in the levy. Now, the bill does actually restrict levies a little bit. It does restrict the maximum levy growth quotient to 4% in 2026. It puts some restrictions on new debt service levies. It makes some changes that will probably make referendums a little harder to pass for school districts. So we may see slower growth in the levy as we go forward. But 4% is slower growth than what we've seen in the last 6 or 7 years. If it grows 4% and net AV doesn't grow at all, and the rate is determined by dividing the levy by net AV, you take a growing number, you divide it by a number that isn't growing, and what do you get? You get tax rates going up. And as you can see, the tax rate extrapolated rises above $3 per $100 assessed value by 2031. I'm guessing that if you look out across all the taxing districts, and taxing districts are those places that have the same set of counties, townships, cities and towns, school corporations, library districts. So you add up the tax rate, and that's the rate that the taxpayer pays. There's 2,091 taxing districts in Indiana. At the moment, 270 of them have rates above $3. I expect the number of districts would double or triple with rates above $3. And as we'll see under SEA 1, a $3 rate is a really important threshold. But before we get to that, let's take a look at what's going on with the shares of property types in net assessed value. Now, net assessed value shares translate into the shares of the tax burden that you bear, right? Your share of taxable property in the tax base of your community is pretty close to the share of the property taxes that you pay. So what's happening to the shares of the major types of property between 2025 and 2031 as we've extrapolated it? What we see is the business real share going up from 19% to 26.3%. Business personal down from 12.1 to 11.1. Farmland down from 5.9 to 4.1. Non-homestead residential down from 20.7 to 19.2. Homestead share down from 42.3 to 39.3. The residential share, rental and homeowners, is lower than it would have been, from 63 to 58.5. The business share is up from 19 to 26.3. So SEA 1 shifts taxes, property taxes, from homeowners, farmers, and rental housing owners, from homeowners, rental housing owners, and farmland owners to businesses, especially businesses that have more than $2 million in acquisition costs and don't get that exemption. What are the businesses that have more than $2 million? Big businesses. This bill shifts taxes to big businesses. But homeowners, I suspect, were the reason for property tax reform. Historically, you look at my paper, past 50 years, every time homeowners get unhappy about their property taxes, we see policy change. So let's see what's going to happen, what might happen to homestead tax bills as we move forward. First of all, let's talk about the importance of the $3 rate. You may know that we have circuit breaker caps in our Constitution of 1%, 2%, and 3%. And that means that your tax bill can't be higher than that percentage of your gross assessed value. So if you look down the line here for homesteads, let's suppose we had a gross AV of 300,000. We took 1% of that. That would be 3,000. And that's the circuit breaker rate for homesteads. It's 1%. So $3,000 is the maximum amount that you could pay on a $300,000 home. Why 300,000? It makes the arithmetic easy. Under SEA 1, we're going to have a 66.7% deduction, which puts us down to $200,100, right? 66%, just a little bit higher than two-thirds, which leaves a net AV of $99,900, just a little bit less than one-third. The amount that the tax rate required for $3,000, that is to hit your cap under the Constitution, with a net AV of $99,900, is just over $3 per $100 assessed value. We do the same for residential and farmland. $300,000 at 2% is $6,000. That's the maximum amount that an owner of this kind of property would have to pay. We give them a deduction of just over one-third. That's $100,200. $199,800 is the net assessed value. What tax rate would be required to raise you above $6,000 and make you eligible for the cap if your property is valued at $199,800? A rate at $3.03 or above. Likewise for business, no new deductions. To get to $9,000, you need a $3 rate on $300,000 of property. What this means is, if the district tax rate is $3, nobody has to pay any more taxes. Everybody will be eligible for the caps. Now, businesses and some other property gets some, businesses get abatements, other property gets some little veterans deductions and that sort of thing. So the blanket statement, $3, needs a caveat. But generally, if the district tax rate is above $3, then homeowners, rental housing owners, farmland owners, and businesses are at their cap. And what that means is that when the district rate goes above $3, there's no more property tax revenue to be had. When the rates go above, when the rate goes above $3, the only thing that the individual unit rates, the county rate and the city rate and the school rate, the only things those do is divvy up the fixed pie. But there's no new revenue to be had over $3. So $3 rate under SEA 1, very important threshold. All right, let's calculate a tax bill for in three circumstances here. The current tax bill for the average homestead, gross assessed value $234,500. That same current tax bill, then under the current system, if that value goes up 5% per year, as we've been assuming, and then what will happen in 2031 to that homestead. So first column, this is the information sheet that you get every spring from your county. Gives this information in exactly this way. So let's take a look. A gross assessed value of $234,500. There's your $48,000. We've done that before. There's the remainder. There's the supplemental deduction. Net assessed value, a little bit less than half of the gross assessed value. The district tax rate, average right now, 238.4, gives a gross tax bill of $2,779. In 59 counties, there are local income tax credits for property tax relief. That is, we have increased the income tax, taken that money, and bought down the property tax for homeowners by subtracting a percentage off of the gross tax bill. The average percentage of that lit credit rate is 16%. And so in 2025, the reduction would be $445. That would put the tax bill at $2,334. 1% of $234,500 is the cap, the tax cap under the Constitution. That's $223.45. The actual bill is slightly less than that amount. So the tax bill after the credit is $23.34, and that's what this homeowner would pay. In 6 years, at 5% annual increase, what do we see? We see a net assessed value that is more than half. Again, because the 48 didn't increase, right? It's fixed. Let's assume that the tax rate didn't change. If the current, if the current system didn't change, that wouldn't be true. Actually, the tax rate would go down under the assumptions I've made, as it has gone down over the last 3 years. Yes, the levy's gone up, but AV's gone up more and the rate is lower. Just because the rate is lower doesn't mean you pay less, of course, because your assessed value has gone up more and then your rate has come down. Nonetheless, rates have been coming down. But let's be conservative again and leave it the same. The gross bill is $39.67. 16%, that is the lit credit rate of 16%, subtracts 635, that gives us $3,333. The tax cap at 1% of that, 314 up there, is 3,143. And that means this homeowner gets a tax cap credit of $190 to bring that tax bill down to the cap rate. That's 3143. And so you see that's an increase there of about, what do we got? $809, I think we have, right? Okay. Now, what will it look like under SEA 1? Same gross assessed value, no standard deduction, that's gone. So the remainder is the same, 67%, so about 2/3 of this total, 209,606. Taxable is subtracted, taxable net assessed value, 104,646. As we've already seen, taxable net assessed value goes down. The district tax rate, as we just extrapolated, goes up to $3.12. There's a $3 rate. And that gives us 3,268. SEA 1 eliminates the lit credit rates in pay 2028. They go away. So that subtraction doesn't happen. And we get a tax bill after the lit credit of $32.68. That is higher than the tax cap by $126. And so this taxpayer would pay $3,143, the same as they would have paid under the current system, except for the new supplemental homestead credit rate as of 2026. After the calculation of the CB credit, of the circuit breaker credit, after we get to what was the last step in the tax bill, we're going to add a new step. We're going to subtract 10% up to a maximum of $300. Now, 10% of 3,143 will put us at that $300 maximum, and the tax bill will be $2,843, $300 less than it would have been, but $509 more than it was. And folks, here it is, right? If you take that, the analyses that are done comparing taxes to what they would have been, see your taxes are going to be less. Please do not assume that that means your taxes are going to go down from where they are now. Probably not. Your assessed value will continue to increase. Tax rates are going to increase. Tax bills are going to be increased too, but they're not going to increase as much as they would have under the current system for the average homeowner and for most homeowners. Let's take the results of this analysis and do it every year from 2025 to 2031 as SEA 1 phases in and see what happens to the taxpayer every year. We start out with that tax bill of 2331. So this is the same as the numbers that I just gave you. What happens in the first year? Well, in the very first year, the supplemental credit kicks in, and it's 10% of the tax bill. And that reduces the tax bill from what it would have been by a little more than 10%. 10% from the supplemental credit, then a little bit more because the supplemental deduction begins to phase in at that point. However, the rate has gone up and the assessed value has gone up. So the percent change year to year is 5.4%. It's 5.4% decline. I think it's true for most homeowners that you will see a reduction in your taxes from 2025 to 2026. Now, that'll depend on what happens in your local community, what happens to tax rates in your local community, but I think the average homeowner in the average community will see a reduction from 2025 to 2026. But that's the last reduction you're likely to see, because in the next year, taxes rise by an extra amount because we're yanking personal property under $1.12 million out of the tax base. That is acquisition costs under $2 million. And again, this is the maximum amount of loss. But what that does is to raise the tax rate a little more. And so we get a 5.4% increase in the tax bill for this homeowner. It's still 10% lower than it would have been because of the supplemental credit, but it's now just a little bit lower than it was in 2334, only lower by what, about $7. So a 5%, so the changes in 2027 basically erase the reduction that took place in 26. Then comes 2028. What happens in 2028 is the elimination of the local income tax, property tax replacement credits. And if you're in one of those 59 counties, you're going to lose a credit, and that will cause an increase. But the increase here is only 5%. Why? Because at that point, the average homeowner hits their cap, hits their circuit breaker cap, and that means that their taxes simply rise at 1% of their gross assessed value, which we've assumed will rise at 5% per year. So from here on, from 28, 29, and 30, your taxes are 10% lower than they would have been because of the supplemental credit, but 5% higher every year because your gross AV is growing and you're being taxed essentially at 1% of that. And what happens in 2031? Well, here you notice the increase is 5.5% and the decrease from what would have been is only 9.5%. That's because at this point, you hit your $300 peak on the supplemental credit. It's no longer 10%. Now it's just $300. Now it won't rise proportionately with your tax bill. It'll just fix at $300. So what can we say about the average homeowner? Their taxes will be lower. Make no mistake about that. Their taxes will be lower than they would have been under the current system. So it is a tax cut under that means of analysis. That's a real means of analysis, real method. But relative to what it would have been, your taxes likely to continue to rise year after year. Now, this is for a 234. This is for the average homestead with gross assessed value rising 5% per year at a tax rate that winds up over $3 in 2031. Everybody will be at their tax caps if the tax rate is above $3. And we want to look at some homeowners that are not at their caps, because once you hit your caps, then it's just 5% annual increase, right? Less the supplemental credit. By the way, this is a real simplification for a whole lot of homeowners. What are your property taxes? Take your gross assessed value, what the assessor thinks your house is worth. Take 1%. That's the constitutional tax cap. Subtract 10%, the supplemental credit, and that's what you pay. Very, very simple. So let's take instead a high-valued home in a rural area. This is a $400,000 homestead. Gross assessed value, again, rising 5% per year. Let's start with a $2 tax rate. So that's a rural tax rate. And let's increase it proportionally the same way that we increased the other one, but that puts it up only to $2.60 by 2031. So it will be below 3%. So it will not be the case that all property owners will be at their caps. And let's again have a 16% lit property tax relief credit. So this is a higher valued home. So naturally the tax bill is higher. What happens in the first year? You get a decline. It's 8.8%. Why isn't it 10%? Because this taxpayer's at the $300 maximum on the supplemental credit from the get-go. Right? Their tax bill is over $3,000. So their reduction a little bit less. Tax rate then rises by the personal property exemption. You can see here an increase. Again, it turns from a decrease to an increase. The increase is a little bit less because the supplemental deduction, that percentage deduction, is starting to increase, and that's more valuable to a more valuable home. We get out here into 2028, and what do we see? The elimination of the 16% PTR credit when a homeowner is below their cap causes a really big increase in the tax bills that they pay. And so now it's hardly lower than it would have been. But as we move forward from there, this homeowner does very well. And the reason is that the elimination of the $48,000 deduction doesn't much matter to a homeowner with a home this expensive, but the additional 66.7 phasing in, that is really lucrative for this homeowner. And so these homeowners see actual decreases year to year in 2030 and 2031 under this extrapolation. And we wound up with a tax bill that's 14.6% lower than it would have been, but still higher than it was. Right? Yes, you get a decrease in 2026, but increases enough in 28 and 29 so that the number at the end is higher than it was. Now let's talk about a low-valued home in a rural area. Let's take a look at that $80,000 homestead with gross AV rising 5% per year. Let's do the $2 rate so that the homeowner's not at their caps. And again, the 16% lit property tax relief credit. The $80,000 homestead at the $2 rate, we end up with a tax bill of $336. In the first year, it's also $336, even though it's 11% lower than it would have been because of the supplemental credit and the increase in the supplemental deduction. Remember, the standard deduction, the 48,000 phase out doesn't start till 2027. But it turns out that the increase in the tax rate is just enough to offset the supplemental credit, which of course is a little at 10% is a little less lucrative for a homeowner with a small bill. And so it basically offsets. So for this homeowner, they don't really get a tax cut in 2026. They pay the same. They don't see an increase as they would have under the existing system, but they don't see a decrease. And then what happens? Well, then this homeowner begins to see some really big increases in tax bills. The tax rate rise in 2027 since this homeowner is below their cap and they're not benefiting from the big new supplemental deduction very much because percentages of small numbers are small numbers. They see a 29.3% increase in their tax bill under this extrapolation, and it's actually higher than it would have been. In 2028, the elimination of the 16% lit PTR cap has a big impact on this homeowner because they're below their caps. And we see a 42.8% increase in their tax bill. And then further increases, further big increases. Why? Because now you're losing that $48,000, that really lucrative $48,000 for a low valued home, and gaining the supplemental deduction percentage, but it's a percentage of a small, relatively small number, a relatively small home value. What do we end up with at the end? $842 compared to $336 at the beginning. Their tax bill is more than doubled, and their tax bill is 35.4% higher than it would have been. Summary and conclusions. Right. Here's the slide that just shows what happened, right? What SEA 1 is going to do, phasing in deductions, phasing in exemptions, eliminating the local income tax credit, creating the new supplemental homestead credit, $2 million exemption for a personal property, eliminating the 30% floor on new equipment, and then the other major changes that I didn't cover here on local income taxes and property tax referendums. We've got the, and here basically summarizing what we've done. Deductions, exemptions, assessment changes in SEA 1, if applied in 2025, would reduce net AV by about a quarter and raise the average tax rate above $3. Extrapolating forward with what I hope are plausible extrapolated growth rates, net AV grows little or declines from 2025 to 2031. With levies growing 4% per year, that means the average tax rate rises above $3, and we'll have a lot of districts with rates above $3. Most urban districts will be over $3. I'm tempted to say all urban districts, but you never know. But most urban districts, and that means that a majority of homeowners will probably be in places where the rate is more than $3, so they'll be at their caps. Most property reaches the circuit breaker caps at a $3 rate, and so local governments can't raise any additional revenue when the rates of all the units in a particular district rise above $3. The tax burden is shifting away from most homesteads, most other residential and farmland, to businesses, especially big businesses that continue to pay personal property taxes, but taxes are also shifting to owners of low valued homes, right? Low valued homes under about $103,000 in 2025, likely to see higher taxes than they would have been by 2031 than they would have been than they are now. So increases for those. So you got a policy here that shifts taxes from most homeowners, from farmland owners, from rental housing owners, and from some small businesses to big businesses and owners of low valued homes, especially in rural areas. Business person property gets no new deductions. Places with lots of personal property tend to have large firms that will continue to pay personal property taxes. These are the rules of thumb on what happens, which counties likely lose more net assessed value, which ones likely to lose less. And again, what counts? The rule of thumb, how much business property have you got in your assessed value? And then finally, the homestead thing that I talked about a little too, one slide early. What happens? The average homeowner ends up at their caps. You have this very simple system of gross assessed value, 1%, less than 10% supplemental credit. Now, the referendum rates are outside of the caps. So if you're in a place that has a school referendum tax rate, then you have to go through all the deductions and the calculation of the rate and everything to figure out your bill. But if you're not there, and you're in a place where the rate is above $3, then your tax bill, your property tax, is going to be very, very simple to figure out after 2031. High-valued homesteads see bigger reductions in net AV due to the rise in the supplemental homestead deduction. Low-valued homesteads, not at their caps, likely to see much larger increases in taxes above what it would have been because of the loss of the fixed $48,000 deduction. That's what's in the paper about property taxes. That's what I have to say about the Indiana property tax reform of 2025. This paper may have a short shelf life because by next year, not only will we have actual data, but I suspect the legislature will be looking at some of the consequences that are starting to come out about this policy and saying, well, maybe we can tweak this, maybe we can tweak that. So I suspect over the next 6 years, the reform will evolve, will change a bit. But as of right now, that's what we've got. And thank you very much for listening. And do visit the Indiana Fiscal Policy Institute website and take a look at all the great information that they've got there. This is a terrific organization that provides really objective policy information just for Indiana. But take a look at the 3 papers I've written and this most recent one, the Indiana Property Tax Reform of 2025. Thanks very much.